Mr. Ben, thank you for joining us. Let's start this interview and ask you about the markets. And as you know, markets continue to reach record high despite geopolitical tension and economic uncertainty. So what do you think, Mr. Ben, investors are underestimating today?
Yeah, so I think it's been a very interesting and busy period of time in the global economy, global geopolitics, and global markets. The fundamental driver for market performance is earnings. So I think there are many, I shouldn't say distractions, these are very important issues, not least the geopolitical situation we've had here in the Middle East over the last several months. So they're, of course, very important. But driving markets forward has been earnings, the amazing earnings super boom driven by technology, by artificial intelligence. That's been the dominant driver. So our view from BlackRock, the world's largest investor by far, is investors need to stay focused on the fundamentals, how much money these companies are making. It's a lot and it continues to positively surprise us. And that's what's driving markets forward, even with all of these difficult, more complicated situations in the background.
So where do you currently see the biggest disconnect between the market expectations and the economic reality?
So I think the economic reality is hard not to talk about artificial intelligence. So the biggest disconnect potentially is on how much demand there can be and the scale of the spending coming through to build the AI infrastructure, the AI kind of architecture that's creating this intelligence boom right now. So I think the big disconnect is to be looking at, if I can say, a traditional playbook of a cyclical economy and a cyclical market when we seem to be going through a significant structural change in how the world works. This includes geopolitics, by the way, but the AI revolution is completely central and is potentially a structural change to the nature of the economy, markets, perhaps even society itself.
As we know, AI has become one of the biggest investment themes globally. Do you believe markets are experiencing another technology bubble, or are we still in the early stage of structural transformation?
I think we're still in the early stage of the transformation. Intelligence is very unusual as a commodity. We've never found a resource. It's like finding a huge oil reserve or something. We found an intelligence reserve which is growing and growing and growing. So this is very strange in a way, very unusual, and I think is a structural change which we're in the early stages of. Now, from an investment perspective, we need to be very focused and move the conversation away from a general excitement, which we definitely have, and to be focused much more on the particular investment opportunity. So we at BlackRock are really focusing on the constraint, on the bottleneck. In a way, bottleneck is a good news. What it means is they need investment. And so us as a capitalist, as a provider of capital, that's where we can be looking to invest, whether it's in the chips, the power, the data centers, where there is clearly not enough of these things. That's where we're looking to find scarcity, to find that constraint. We think those are the particular investment opportunities within the overall AI, I think we can call it revolution, which we think is in the early stages.
Global capital continue to flow into the Gulf. Has the Middle East become a strategic investment destination, or is still viewed as an energy story?
I think it is becoming more and more perceived as a regional center and increasingly a global center. So for a long time, of course, I think the foreigners have understood the Middle East to be an exporter of capital, using the extraordinary wealth generated from energy disproportionately over the last many years and decades to invest all over the world in many different assets, public markets, private markets, and so forth. That will continue. But it seems to us now the GCC is becoming an interesting investment destination. This is increasingly true, I think, and the AI revolution is part of this. For AI, you need energy, you need a regulatory framework with a can-do approach. You need the human talent, the human capital. So when we look at the GCC, it seems to us that really the GCC is double ticking every box, not just ticking, really double ticking every box. I think the foreigners are increasingly aware of this, so we will see global capital start to come into this area, both in public markets and in the private markets around the infrastructure, whether that's, if I can say, old-fashioned infrastructure, schools, hospitals, this kind of thing, and of course the new exciting infrastructure around artificial intelligence and the power and energy that is required to keep the artificial intelligence going and growing.
Cool. So, as a BlackRock, how do you see the opportunities here in the Gulf? Are there any specific sector you focus on?
Yeah, so the first thing I would say is this is very obvious for your audience, but of course for the foreigner, they're still learning about the GCC. And it's not all the same, actually. So there is interesting relative different opportunities, some attractive, some more attractive. So this is the lens we're really trying to bring to the Middle East, is to be more specific, really pick our spots. And one way we can do this, we think, is if we start with these huge global drivers. So we talk about artificial intelligence, we talk about demography, you can talk about the geopolitical environment. Really, if you start with this as being the key drivers of everything, including markets, including the economy, if you have that lens, the Middle East, I think very naturally, GCC very naturally becomes an increasingly important part of a global portfolio.
So what sectors in the Middle East attracting the strongest interest from the international investors today in the markets?
I think there's a clear theme globally, but has a relevance here, which is more self-reliance. So what we have maybe sadly started to move towards in the last 3 or 5 years is a less trust in the globalization, is a more we need to look after ourselves, most obviously defense, but not just defense, energy. Maybe we all need so-called sovereign AI. We don't rely on the globalized version. We want to have our own version here. So I think this is a global trend. It seems to me the Middle East, GCC in particular, has the funding to create this self-reliance. So I think the opportunity here is, there are many opportunities here, but this is a particular theme, this kind of growth in independence, being able to look after ourselves a little bit more. Of course, it's still a global interconnected economy. It's still very important, but having more self-reliance, be that in defense, be that in the economy, be that in, of course, we want to have more redundancy, more kind of capacity in the energy space. These kind of investments we think are going to be successful here in the GCC.
Markets continue to debate the path of interest rate. How should investors position themselves if rates remain higher for longer?
Yes, we think rates will remain higher for longer. By the way, inflation continues to be a problem. So we have a world of scarcity. So we talked about chips and AI. We have a scarcity in different parts of the economy, which seems to be keeping inflation high. So it's quite interesting. In America, in the US, inflation has been above target for 5 years now. This is a problem. So the Fed is a little bit stuck. It's hard for them to cut rates when you have an inflation problem, meaning too high. And they have a mandate. Mandate means mandatory, means they have to. True. So they probably a little bit wait and see. They are also confused by a very complicated world, so they will be on hold. So this is the reality that investors are going to be confronted with. This means earnings really matters. So when you have very low interest rates, maybe you can create an everything bull market. Really everything does well. Now you have a higher interest rate environment. Some companies will flourish, some companies will fail. So the different investment approach we think is necessary is to have a more active approach to your investing. Can't just be long everything, unfortunately. We will need to do a little bit work and really pick our spots with a more granular lens on where we think we can have the earnings. So the key answer is earnings. Where can we have a confidence that earnings will persist and even grow, even in the face of interest rates higher for longer?
Private markets have become increasingly important for institutional investors. Do you expect private assets to outperform public markets?
I think private markets are going to play an increasingly mainstream role. We still group them under this label alternatives. I think over time this is going to become more and more normal for, as you say, institutional investors. But actually over time, I think even if I can say normal people are going to be thoughtful around, for example, if you look at the most exciting technology companies in the world, many of them have been private for a long time. So as an investor, if you want to have exposure to some of the most exciting new technologies out there, which by the way are generating a lot of returns, generating a lot of cash flow, it is necessary to think about how we can access that. And that's going to be, at least in part, through private markets. So the importance of private markets, we think, is only going one way, is only becoming more important. Yes, for the big institutions, that's for sure, but actually maybe even for normal investors over time.
Mr. Bin, what's one investment mistake you believe too many investors are making today?
I talk about the danger of cash is a bit of a strange comment, so let me explain this. We often hear investors talk about, I have no risk on, I'm all in cash. I think this is a little bit of a mistake. If you are all in cash, it's a big bet. It's a big bet against the market. In the last 18 months, we've had some really scary moments. We had Liberation Day with the tariff kind of shock. We have a geopolitical shock in Russia, Ukraine, and of course, closer to home here in the GCC, we have many shocks. So it's quite reasonable, you might think, that you so-called take risk off and put it in cash. It turned out this was a big bet, and it turned out to be a little bit the wrong bet. So we would encourage people to be very focused. What are you trying to do? You're trying to put your kids through college. You're trying to look after your retirement and so forth. And to achieve this, you need to have, we would argue, a well-diversified portfolio that is aligned with those goals. So the difficult thing is to try and stay close to what your goals are. Really stay focused on this and try not to be scared away by what is a scary world. It is a scary world. Stay focused. What am I trying to do? Stay focused on the portfolio that aligns with that, and then be hard to move away from your goal.
Mr. Ben, let me ask you very clearly. Is cash still king, or has that era ended?
Cash is a minor royalty these days, I think. So it's still important. Cash can play a role in the portfolio. Many people will need cash if they need to fund a particular purchase. Sure. So cash is very important. We all like it, that's for sure. But I think within a well-diversified portfolio, particularly in a world where inflation is a bit high. Inflation, they call it the thief in the night. So you have cash, feels good, but you're getting poorer every day. If a cup of coffee getting more expensive every day, then the same cash doesn't buy so much coffee. So be careful of inflation, really be careful. And cash, of course, is useful. It plays a role in all of our lives, but is only a small part, we would suggest, of an overall portfolio to keep you aligned with your goals and to defend you against the menace of inflation.
BlackRock report argues that in a higher rate world, income is back. What type of income generating assets do you find most attractive today?
Income is back. So we really have a difficult 15 years where we have ZIRP, they call it, zero interest rates, and even negative. It's really an unbelievable time in economic history. Over the last thousands of years, you don't have this. Now we come back to something more normal where you have an interest rate. It starts with a plus sign, which is a good thing and can pay you some income. However, there is still some risk here. We a little bit are concerned that the US Treasury yield can go up a little bit. This means the price can go down a little bit. So we think you'll need to have a diversified range of assets to pay you that income. So for sure, government bonds are still part of the mix. But before, they did everything. They were really fantastic. Now we probably need a little bit public credit, maybe some private credit, maybe some dividend equities, and so on. So now I think to achieve this sustainable income, we're going to need to have more of a mixture of assets to pay you that income on a durable basis.
So let me finish this interview and ask you about a BlackRock outlook of the GCC markets and worldwide. How do you see and what's the outlook?
We're still quite positive. We're still quite positive. Human ingenuity is flourishing. We're seeing the world create astonishing technology, astonishing ideas. And more than this, it is creating companies that are generating really unbelievable return. I mean, astonishing. So I think this is a good moment for investor. Of course, be careful, be diversified, be focused on your goals. But as a general statement, we're quite optimistic for the world, the global economy, the global market, and in particular here for the GCC, where BlackRock, the world's largest investor, we're not just excited about the market, we're opening more offices, we're hiring more people, and it's a very, very exciting time, it seems to us, for BlackRock, very, very exciting time for the GCC, for the markets, and for those of us also lucky enough to live and work here.
Mr. Ben, thank you very much for this interview and all of this information. Thank you very much.
Thank you very much. I appreciate it.